If you're looking for some last-minute tax tips before filing your 2022 taxes, today's episode is for you. We're going to talk about strategies that you can utilize to still reduce your 2022 taxes or utilize to get some tax-free money growing for your future.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome into another episode of The Retirement Show, all about your life, your money, and your taxes. And that's actually what we're going to talk about today is last-minute tax tips and tax strategies before you file. So if you had wage income in 2022, or maybe you were a 1099, or if you were self-employed, we're going to talk about some last-minute tips and strategies before you file your 2022 taxes that might help put more money in your pocket or might help you in regards to your long-term tax burden. So that's what we're going to talk about today. I'm your host, Scott Searins, and my goal is to help you thrive in life, wealth, and retirement. If you haven't yet, we do have a YouTube channel. We would love if you'd check that out. It's Searins Financial Group, S-I-E-R-E-N-S, Searins Financial Group, or you can go to lifemoneyshow.com. We have a link to our YouTube channel there. So our latest videos, I know we're talking this episode here is about 2022 tax tips, but our latest episode on YouTube was actually 3 ways to reduce taxes in 2023. So 3 ways to help reduce taxes in 2023. Also had a video out there in regards to if you're wondering if you can retire, it's the 10-point retirement checklist. I think you'll find both of those really helpful. Again, go to YouTube, check us out, Searins Financial Group, or you can go to lifemoneyshow.com and click on our YouTube link. As I had mentioned, today's all about last year. Today is all about helping you out before you file your 2022 taxes, which are due on Monday, April 18th. Maybe you've already filed, so at which point you can just hit skip, go to the next episode, or listen in because you know what? It may help you in regards to your future. You might want to look at what you did submit, and maybe there's something you want to change. Maybe there's something you want to amend. Maybe there's a way where you can reduce your taxes for last year. Now, to be frank, a lot of things had to be done in 2021, or I'm sorry, in 2022. My mind is going backwards, but anyways, as you caught on there, you would have had to do most of the things from a tax strategy standpoint in 2022. But there are a few things that you have until the tax filing deadline to still do before you file your 2022 taxes. So if you, now this, I will also say a lot of these, let me walk through them all here on my papers. A lot of these basically apply to those who had wage income last year, if you were a 1099, or if you were self-employed. If you're already retired, I'm not necessarily seeing how you would be able to use any of these strategies unless your spouse has wage income coming in, then you will be able to use one of the strategies that we're going to talk about today. So let's start from the top. What are some strategies that you can utilize for your 2022 taxes before you file? And the first strategy here is being able to make contributions to your IRA. Now, the contributions that you can make to your IRA is $6,000, and if you're age 50 plus, you're able to make the $1,000 catch-up contribution, which make a $7,000 total contribution that you can make to your IRA. When you make that contribution to your IRA, what that does is it reduces your taxes today. So if you're looking for tax reduction strategies on your 2022 taxes, let's say you're making $100,000 and you make a $5,000 contribution to your IRA. Well, now your taxable income went from $100,000 down to $95,000. Now, just be aware there are phase-out limits to be able to, when it comes to deducting IRA contributions. So, for example, if you're married filing jointly, the phase-out starts at $109,000 of adjusted gross income. And then if your total is $129,000 of adjusted gross income or more, then you're no longer able to deduct your IRA contributions. If you're single, the phase out starts at $68,000 and goes at $78,000 or more. You're no longer able to deduct your IRA contribution. So if you're looking for a tax reduction strategy for 2022, make a contribution to your IRA as long as you fall within those limits. Now, for everything that I'm talking about today, I would highly recommend make sure you consult with your financial advisor as well as your tax preparer to make sure that these are strategies, these tips that we're talking about, you can actually utilize in your specific situation, because as you know, everybody's situation is different. So there we go. That was number one, the IRA. Now remember, with the IRA, the traditional regular IRA, when you put money in, you're basically kicking the tax can down the road. And if you've heard any of our episodes before, you will also realize then you are just saving money into that tax deferred bucket, where you will then, depending on your age, right now based on IRS rules, either at age 73 or 75, you're going to have to start taking those required minimum distributions, that forced income that the IRS is going to make you take out of that bucket. And depending on how much you save in that bucket, you could be putting yourself into a higher taxable income in your future than where you're at today. So IRA could be a good thing for today. Let's say you're in the 30% some tax bracket. Well, maybe you want to kick that tax can down the road to the future, where you can potentially get that money out at a lower tax rate. But if you're in the 10s and 12s and in the 20% tax brackets, maybe the IRA is something that you don't want to consider. Again, your situation is unique, and that's why you want to consult with a financial advisor who's looking at your overall picture and putting together a tax plan and projection for you. All right, got off on a little tangent there, but let's talk about the second tax tip, tax strategy that you can do for your 2022 tax filing, and that is making a contribution, ready, drum roll please, to the Roth IRA. Now I know what you might be thinking, wait a second, Scott, I don't get a tax deduction. How is this helping me out? Well, how this is helping you out is that all of us only get so much that we can contribute to a Roth IRA each and every year. That's the bucket where, yes, you pay tax today, but the money then grows tax-free, and every penny that you take out in the future, not only what you put in, but also the growth, you get to withdraw that tax-free as well in your future. So that's why I'm saying this is a last-minute tax tip, because you can only put in so much each year. You might as well take advantage of what you can put in for each year. So last year, same as the traditional IRA, for the Roth IRA, the contributions that you could make were $6,000, and then if you're age 50 plus, that additional $1,000 catch-up contribution for a total of $7,000. Now, the Roth also has contribution eligibility limits, meaning there are phase-out ranges. So for married filing jointly, starting at $204,000, it's going to reduce how much you could put into that Roth. And then if you're at $214,000, now these are modified adjusted gross income numbers, $214,000 plus, then you're no longer able to put into the Roth IRA for 2022. Single, that phase out starts at $129,000, and then full phase out, where you're no longer able to contribute, $144,000 of modified adjusted gross income. If you fall under those phase outs, under those top numbers for those phase outs, this could be a good way to get more money into your Roth IRA. So if you didn't make those contributions for 2022, you're sitting on maybe some money in your savings account, in your checking account, in your bank account. You're just, think about this. Maybe you have $50,000 or $75,000 or $100,000 just sitting in your bank account. Now, hey, we are getting higher interest rates. So that interest that you're earning on those bank accounts, you're getting taxed on that each and every year. Or another thought process is you could just carve off or if you're age 50 plus, carve off $7,000 from that $100,000 or $50,000 that you have in that bank account that are, again, you're getting taxed on that interest. Move it over to your Roth, and then there you go. You're no longer getting taxed on that interest. So while you might look at it as like, hey, I'm not making getting a huge tax deduction today, you could be saving on interest that you would be paying taxes on in other accounts, saving on the taxes that you'd be paying on interest in other accounts. There we go. Just had to flip around the words a little bit. So number 2 there was the Roth IRA. Let's move on. Number 3, still staying in the IRAs, we're going to say spousal IRA or spousal Roth IRA. If you're in a household where one person is working and one person is not working, it doesn't mean that the person not working, even though that they don't have wage income coming in themselves, they are still able to contribute to IRAs or to Roth IRAs as long as the household had enough wage income to meet the limits. So for instance, if your household had $5,000 of wage income coming in, well then the total amount that you could put into an IRA or Roth IRA would just be $5,000. If the household had $100,000 of wage income coming in, but only from one person, well, that's okay, and you're a couple, right? That's okay, but because there's $100,000 of wage income coming in, let's say we're age 50 plus, so you can do the catch-up, so $7,000 total that you could maybe put into the IRA or the Roth IRA. Well, then you could do $7,000 for one person, $7,000 also for the other person. I see this one get missed all the time, where one person has retired, the other person is still working. Utilize that to still contribute. Utilize that to still get money into that Roth IRA. Shift money over into that Roth where it can grow tax-free, or maybe dependent on your situation, you want to put it into the IRA. Either way, utilize that wage income that you have coming in as that ability to make contributions for the non-working spouse. All right, next on our agenda here is the HSA or Health Savings Account. Actually, if you are checking out our YouTube channel, we have a great video on health savings accounts, the benefits of them. The title of it is Tips to Maximizing Your Health Savings Account. So go to YouTube, check that out. But we're going to talk about HSAs here on some last-minute tax tips and strategies for your 2022 taxes. If you had an HSA open in 2022 now, and you had a high deductible health plan, then even though we've gone past the end of the year, you still have to the tax filing deadline to be able to contribute to your HSA for 2022. So just like your IRA, Roth IRA, spousal IRA, and spousal Roth IRA, all those contributions, you just have to make them by the tax deadline for your 2022 taxes. You can do the same with your HSA. Now, as a single, your HSA contribution can be up to $3,650. As a family, $7,300. Take a look at how much you contributed. Did you hit those numbers? If you fell short, maybe you put in $2,000, maybe you put in $3,000. Well, now's the time to go back and put in the difference. And here's the benefits of doing that. This is one that you will get a tax deduction. So the more you put into your HSA, you get that tax deduction. It grows tax-free, and then all of your withdrawals for qualified medical expenses are tax-free as well. So it's kind of like the triple tax advantaged account. Get the tax deduction, grows tax-free, withdrawals tax-free. Now, if you're age 55 plus and you've got that HSA set up, you can actually put in an additional $1,000 to your HSA account from those values I mentioned earlier. Age 55 plus is the catch-up contribution age for HSAs. So the small caveat here, and this was a lesson that I had learned in the past, is that if you did not have your HSA set up in 2022, so like 2022, you're in a high deductible health plan, and now you're going, oh, I wish I would have put that money in. I'm going to go start an HSA and put money in it for 2022. If you did not start it in 2022, unfortunately, you cannot make contributions for 2022. But if it was started and you hadn't maxed it out, you hadn't hit those values that I was talking about earlier, there you go. Great way to get another tax deduction for your 2022 taxes. Okay. Now, the next would, I would say, apply more to those that maybe are self-employed, 1099, or own a business. And some things that you can still do for your 2022 taxes or make contributions in regards to for your 2022 taxes is the SEP IRA. So in 2022, you can contribute up to 25% of your compensation. Now, dependent on if you delay your taxes or ask for extensions, I'm going to say the kind of the final date would be September 15th of when you would have to make this contribution by. But this would be a way for you to reduce your taxes in 2022. You can talk to your tax preparer, or if you're doing them on your own, you're basically going to state, I'm going to make, and as you file, but you're also going to have to do it, is make a SEP IRA contribution, and it would be earmarked then for 2022. The other thing that you can look at, whether you're a small business, self-employed, or 1099, is have you captured all of your write-offs? And I'd really challenge you, you can't go back to 2022 and spend more money, but I'd really challenge you to go back through your books, go back through your receipts, go back through just your calendar and your history to look at everything that you did last year. And are you capturing all of your write-offs? Are you capturing all of your write-offs for travel? Are you capturing all of your write-offs for dining? How about home office? Do you have a home office? If so, are you incorporating that into your 2022 taxes? Are you getting the write-offs for your home office space? And then how about any electronics that you purchased to do business last year? If so, you could potentially have some write-offs there as well. How about your car, your automobile? Were you doing any driving, any traveling for work purposes? If so, that could be a write-off for last year. So the last portion here is I'm challenging you to go back and really look at your books, look at whether it's your credit card statements, your history, your calendar, understand where you went, and challenge yourself just to take that time and go through and detail all of the write-offs that you would have in regards to your business. And that's one way that you can still potentially get some, I'll say, tax reduction, right? Because these are write-offs, tax reductions on your last year's taxes for 2022. So there you go. As you can see, a lot of it is more based on the ability to make contributions to different accounts or to just make sure you're capturing write-offs. Again, we can't go backwards. We can't, go back to 2022 and spend differently or save differently or make Roth conversions. That's too late. Those have 12/31 deadlines. So hopefully you're also listening to this going, wow, I got to make sure I'm organized for 2023. I have to make sure I'm headed down the right path for my 2023 taxes. If so, we've got a great video out there on YouTube, 3 ways to help reduce your taxes in 2023. Highly recommend to go and check that out. Hope you enjoyed this episode. If so, subscribe on your favorite podcast player. We will have links to the YouTube channel at lifemoneyshow.com, or you can just go directly to YouTube, type in Sierens, Sierens Financial Group, and it'll take you right to us. And look at those videos, 3 ways to help reduce your taxes in 2023, as well as the 10-point retirement checklist. I think you'll enjoy them both. Hey, really enjoyed our conversation today. Hopefully the same for you. Don't forget to hit that subscribe button. And I look forward to our next conversation to helping you continue to enjoy life today and be financially confident about your tomorrow.
Investment advisory products and services made available through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc. Bond obligations are subject to the financial strength of the bond issuer and its ability to pay. Before investing, consult your financial advisor to understand the risk involved with purchasing bonds.